Welcome back. In this video, we are going to look at the different common order types available to you. Some of the basic order types include the market order, the limit order, the stop loss order, and combination orders like the stop loss limit and stop loss market orders. A market order instructs the broker to buy or sell the security at the best price currently available in the market. A market order tells the broker to execute the buy or sell trade irrespective of the price available in the market. If you place a market buy order, it is filled at the lowest available offer price. If you enter a market sell order, then it is filled at the highest available bid price. If the quantity available at the bid price is not sufficient to fill the order, then the remaining quantity is filled at the next highest bid. If the quantity at the next highest bid is also not sufficient, then the next highest bid is hit. This goes on till you get a fill for your entire quantity. So in case of a market order, it is possible that you get fill at different prices depending on the quantity available at various prices in the market. The advantage of market order is that it is virtually guaranteed that your entire order will be executed. The disadvantage is that you cannot be sure at what price your orders will be filled. So for example, if at the time of placing your buy order, you see that the stock is trading at 118.7, it may so happen that by the time your order reaches the exchange, the stock has moved to 119, so you might end up buying the stock at 119 instead of 118.70. So essentially, in case of market orders, there is always a risk that the market may move adversely by the time your order reaches the exchange. In order to eliminate the risk, there is the option to place the limit order. In case of limit orders, you are required to specify a limit price and limit quantity. In case of a limit buy order, the broker is instructed to buy the security only if it is possible to get a fill at or below the limit price. Similarly, in case of a limit sell order, the broker sells the security only if it is possible to get a fill at or above the limit price. The advantage of a limit order is that you can be certain about the price at which your order will be filled. The disadvantage is that you can never be sure if your order will be executed. For example, if you want to buy a security at 100, but by the time your order reaches the exchange, the prices go up and do not come back, then your order will not be executed. So this is how market and limit orders work. In the next video, we are going to look at stop loss and some combination orders.